If you have been in crypto for longer than 5 minutes, then you must have heard this one single sentence that this is the top, it's gonna crash. And who knows, maybe sometimes they're right. But here's the problem. Most people predict a crash using nothing but vibes, maybe some articles that they read online, and some fear. So, in this video, I'm going to give you something better than that. A simple scoreboard of the exact indicators I would watch in 2026. Macro indicators, on-chain data, stablecoins, leverage, liquidity movement, etc. Just so you can make your own call without having to trust me or any other influencer out there. And I will show you the exact tools to track all of this by yourself. By the end of this video, you will be able to answer one very simple question clearly. It is the market overheating or is it just breathing? Before we begin, what do we even mean by a crash? In crypto, a crash can be a sharp drop of 20 to 30%. A deeper wipeout could be of more than 50%, or a full cycle drawdown could be of anywhere from 70% to 90%. Something which has historically happened for Bitcoin. If 2026 is going to see a crash, it usually comes from one or more of these buckets right here. I will explain to you each one of these in detail. If you want, feel free to take a screenshot of this image right here. Let's go one by one and I will show you exactly what to take a look at. First one is the macro liquidity. This is to answer the question whether money is getting easier or harder. Think of the crypto market as basically a liquidity sponge. When financial conditions get tighter, the first assets that are to suffer are usually the riskier assets, and in our case, crypto, of course. The first indicator to track the macro liquidity is this 10-year treasury constant maturity minus 2-year treasury constant maturity. I know those are a lot of words, but it's very simple. This yield curve is a classic macro stress gauge. When this spread goes negative, the markets start worrying about a downturn risk. So, how should you use this indicator in 2026? If economic stress rises and market starts screaming recession, risk appetite can fall very fast. A huge disclaimer here is that sometimes market front run recoveries too, so don't use this indicator alone. The next indicator on our list to track macro liquidity is going to be the M2 money supply trend. So, how do you use this indicator to your advantage? One very simple thing to note is that expanding liquidity usually tends to support more risk taking, and in our case, liquidity flowing directly into the crypto market. The vice versa of this is contracting liquidity tends to punish higher leverage as well as risky asset types. And I'm sure you all know crypto falls into this exact category. The third indicator to track macro liquidity is going to be watching what are the rate expectations. By the way, I cleaned up this table and we will fill this table as we go along through the video so that you can follow along with me as well. Instead of guessing the Fed, track what the market is pricing it at. The tool that I personally use to track this is called CME Fed Watch, which uses Fed funds futures to estimate probabilities of different rate outcomes. Please do not get confused by watching all of these charts and numbers. A very simple rule to follow is if markets suddenly price higher for longer, risk can reprice very violently. And if cuts get priced because growth is breaking, that can also be bad short term. Macros are not a single crash button. The reason you need to use macros is so that you can see which direction is market leaning towards rather than listening to influencers or your friends that do not know anything about the crypto market or liquidity. The next bucket on our scorecard is going to be leverage and speculation. A general rule of thumb, if funding goes crazy, liquidations will pile up, and these liquidations could be in any direction. One thing that you need to clearly understand is that crashing in the crypto market isn't just selling, but it's more so forced selling. The first thing to take a look at in this bucket is perpetual funding rates. Think of funding as basically crowd positioning pressure. If we go deeper, then funding is essentially a mechanism that keeps the perpetual price is closer to spot prices. To track this, I personally like to use CoinGlass funding rate tracker. Don't worry, all of the tools that I have mentioned in this video will be linked in the description below. A very high positive funding rate could equal to too many leveraged longs and therefore a risk of a large wipeout. On the other hand, if there is a very large negative funding, then that would equal to too many shorts being opened and therefore there will be a squeeze risk. There is one more thing that you need to do if you want to get smarter in crypto. It's that subscribing to this channel if you haven't done so yet. If you learned something new in this video, then make sure you hit that like button. I will be uploading at least one video a day focused on crypto markets, airdrops, and much more. The next indicator is going to be the ETF flow momentum. This cycle of crypto was very weird because we saw BTC and Ethereum moving not because of retail attention but because of ETF inflows and outflows. It seemed like larger institutions were the ones controlling the crypto market indirectly. Now there are a couple of tools that you can use to track the ETF inflows and outflows. The first one is going to be from the Farside Investors. It is the daily BTC ETF flow table. Can be somewhat confusing if you don't know what you are looking at, but make sure that you are checking this at least once a week and try to understand what's happening. The next tool that I use to track ETF is Bitbo's ETF flow dashboard, somewhat very similar to the Farside ETF flow table. And lastly, you can also use the CoinGlass ETF table, which will segregate Bitcoin ETFs, Ethereum ETFs, as well as Solana ETF. So how exactly do you use this ETF data? Sustained inflows can usually cushion some dips, but a sudden flip into consistent outflows can amplify drawdowns drastically. Now we will move to the third bucket of our scorecard, which is on-chain overheating, or simply translated as are people sitting on extreme profits. If everyone is in profit and euphoric, selling pressure becomes very dangerous. To track this, we are going to use something that's called as an MVRV ratio. Please do not get scared by the name, it's very simple. To track this, I'm going to use Glassnode again. The MVRV ratio is market cap versus realized cap. This is used to estimate when price is above or below fair value and identifies extreme risks. So how do you use this? Well, very simply, if MVRV gets extreme, it would often signal that the market can't handle bad news. Maybe there's a news of Trump conquering or launching an attack on another country, maybe Greenland, or maybe there are more leaks from the Epstein files. Who knows? But anyways, those are the topics for another video. Next, for this bucket, we are going to track something called as SOPR using Glassnode. SOPR is the ratio of realized value at spend versus creation. To translate this in simple language, it just means are coins being sold in a profit or a loss. I don't know why analysts give a very difficult definition for something which is very simple like SOPR. But anyways, a simple ChatGPT search could simplify things for you by 100 times. Anyways, back to SOPR. What do you need to look here? SOPR staying very high can signal heavy profit taking. This can also show that sellers are accepting worse prices for BTC. Let us now move on to the fourth bucket of our scorecard, which is stablecoin and market liquidity. Gone are the days where stablecoins were just used for swapping or used as a store of value. Stablecoins matter now because they are a huge chunk of crypto's cash. Stablecoins are now used for payments, international transfers, remittance, purchasing goods, earning yields, etc. So stablecoins have become a very crucial part of the whole crypto market. The first indicator is going to be total stablecoin supply, and to track this, you can use DeFi Llama's total stablecoins market cap chart. Currently, the total stablecoin supply sits at over $300 billion, and this has went up by close to $3.5 billion in the previous 7 days. So what should you watch here? Rising stablecoin supply can mean more buying power is entering the crypto system, and on the flip side, falling supply can mean liquidity is leaving, which can deepen the market and can cause crashes. The next indicator on our fourth bucket is going to be tracking exchange reserves. I personally feel like that this is somewhat a gray area because there have been times where centralized exchanges like FTX have manipulated their reserve reports, causing into huge liquidations in the market. But anyways, this is still worth a check to see what's happening in the market. If you don't know, exchange reserve simply means the total amount of coins held in an exchange address. Now there is no one tool that can track reserves of all the centralized exchanges out there. What you will have to do is go to top exchanges like Binance, Bybit, KuCoin, etc. and then see whether they have made their reserve report public or not. So how should you use it? Rising exchange reserves can imply more potential sell supply available, and a falling reserve can imply that people are holding off exchanges. Now moving on to the fifth and the final bucket for our scorecard, which is going to be structural shocks. Structural shock, unfortunately, is something that no indicators, no analysts, no economics can predict for you. These structural shocks could be like black swan events, like major exchanges blowing up, for example FTX, a systemic stablecoin stress, large hacks or protocol failures like Bybit hack, sudden regulatory surprises by our favorite president Mr. Trump. There is not much that you can do during black swan events apart from buying BTC or Ethereum for cheap. But if you are all in, there is only one defense for you. It is to be, don't be over leveraged during these times. As a safety mechanism, never rely on one single exchange or one single platform. Now to sum all of this up, we combine everything into 3 clean scenarios where you as a viewer can take decisions for yourself. Scenario number 1, overheated plus tightening. This is where a risk of crash rises dramatically. You will typically see first liquidity tightening, funding rates staying elevated, MVRV ratio at extremes, stablecoin supply shrinking. This usually means market is fragile and also overcrowded, where even your grandpa starts asking you what is Bitcoin and Ethereum. That is one sign to get out of the market quickly. Scenario number 2, cooling without breaking. This phase is of correction and not crash. Here you will see funding sort of normalizing, profit metrics cooling gradually, no sharp dips, and stablecoin supply holding steady. This is a phase where pullbacks happen, but the underlying structure of the whole crypto market does not collapse in one go. This is also called as a sideways market. And lastly, everyone's favorite scenario number 3, which is liquidity wave, also called as full-blown bull market. Here you will see improving liquidity backdrop, strong inflow momentum through channels like ETFs. This is the phase where the risk appetite climbs faster than the fundamentals. For example, you may have seen institutions pouring literally hundreds of billions of dollars directly into BTC and Ethereum. Not just those two, but coins like Solana, XRP, Cardano, etc. I personally don't know why would anyone even touch XRP and Cardano. I guess it's for boomers, who knows. And now let me give you a very simple weekly routine that you can follow and will only take up about 15 minutes of your time. First up, macro check, that will only take about 5 minutes of your time. Next, check CoinGlass funding rates for leverage and speculation. See what's happening on chain using tools like MVRV ratio and SOPR. By the way, you can also use DeFi Llama if you want to check data that is very specific to on chain. Next up, check liquidity. Use DeFi Llama to see where stablecoin supplies are sitting at, and check up what the reserves of the biggest centralized exchanges look like. And if you are doing all of this and 3 or more of these buckets start flashing big red lights at the same time, then you do not need a prediction. What you need is some time to get off the crypto market and start keeping funds aside for dollar cost averaging. What do you think? Will the crypto market crash in 2026? Stay tuned, because next I will go live on this channel and use this exact framework to decide what's happening in the crypto market. And that's all for this video. Thank you for watching. See you all in the next video.